the people that are successful in business are the ones that are paying attention to the detail so that they don't have that scrap. And it might not be in the case of real estate. It might not be in the case of throwing product away, but we throw money away. There's a huge amount of inefficiencies.
Are you frustrated watching your hard-earned money ride the knee-jerking Wall Street roller coaster? Are you looking to diversify into alternate investments and set them on autopilot to achieve financial freedom? It's time to learn the ways of the wealthy. It's time to think outside the stocks with your host, Madhavi Jain, an immigrant from India and ex-IT professional who will bring you industry experts to illustrate a passive and holistic financial approach to build not just passive income, but also your generational wealth. Madhavi is on a mission to change the financial trajectory of one family at a time and 1,000 more to go. Are you going to be part of this vision? And now, without further ado, here is the host of Think Outside the Stocks, Madhavi Jain.
Before we go ahead, just a little bit 2 cents from my lawyer that this is information and education purpose only. If you want to engage with any of our guests, including Shauna, please do your own due diligence. And I'm not particularly a financial, legal, or tax advisor or investment advisor. So please seek your own team, and maybe Shauna would be one of that team members, right? And also we'll have some examples for education and information purpose only. So keep that in mind. These are point in time. These are not representative of any real information. Hey, welcome back to Think Outside the Stocks. I am your host, Madhavi Jain, and I have a person who is very, very close to me, Glenn Hanson, in our studio today, and I'm so privileged to have you here, Glenn. Thank you so much for being here with me and my audience.
Good to be here. Thanks for the opportunity.
Thank you so much. So today's episode is going to be very interesting. LPs as limited partners, they think about investing into real estate, especially the syndicated, in one possible way, and that is being an LP, a passive investor. But today we're going to actually dive deeper into how being an LP, being passive, you can still participate the GP, that is the general partner side of the business. And if you're wondering, what does that mean? Well, the truth is that writing a check to investment as a passive investor, that's not the only way to participate. Behind every successful acquisition, there sits a group who is expert, who are sourcing the opportunity, they have that experience, they're raising capital, they're structuring partnership, they're structuring the deals, solving problems, keeping up with the market up and downs, the challenges that are bringing in. And that's immense amount of people with expertise that are coming to actually make this deal successful. Guess what? There is a way to participate and to invest and believe in them as well. And that is the GP side of business. And that is going to be the main conversation of this episode today. So thanks for tuning in. My guest today, Glenn, has participated in more than $1 billion. Glenn is almost $1.3 billion in transactions at this point, right? With Colony Hills. Yeah. So tremendous experience with Colony Hills. And he has spent years and years, and we will talk about how in building relationship. That is probably the first foundational asset that we're going to talk about is the relationship, right? The relationship with investors, operators, how to bring these acquisitions and capital partners as well, right? What makes Glenn's perspective really interesting that after all the acquisitions, market cycles, he believed that the greatest challenge is not just the real estate itself, is the relationship and how you structured this, right? And that is what the capital structuring as a GP stake, if you haven't heard about GP stake, Tony Robbins talk about GP stake as a holy grail of the investing. So that is what today's episode is going to be. So Glenn, again, welcome back. And let's jump right in. Are you excited to talk about all these, different, deeper topics today?
I am. I haven't heard of GP stakes referred to as a holy grail, but God bless.
Yes, absolutely. So, Glenn, very interestingly, I like to start my episode with the fun facts about guest. It's not your the typical bio that I want to read out, but just the fun facts. It just humanizes us, right? And oh my God, I had such a tough time selecting 3 fun facts about you. There were like probably 10 fun facts, right? So I'm just going to start with it. First of all, wow, you are one of the 10,000 only civilian helicopter pilots in this country. Is that correct?
Yeah, that's the number. It's surprisingly low.
Yeah, it's surprising. So you're like, it's like a really a minority of the civilian helicopter pilots. And actually you have had quite a bit experience by being a pilot and doing some, really good work and connecting and building relationship with people. So that's fun fact number one. Number two, Glenn actually is a serial entrepreneur, right? He has participated in 25 startups, but in his life, the first time when he was 20 years old, he actually participated in a family business, in his family business, and he actually bought that business. He walked away and then bought that business in 1991, and he exited that business in 1999 for $32 million. That's in 1999. And Glenn, you have had several exits after that, and several interesting businesses as well, and would love to know a little bit more into the businesses as we go along, right? So I think that is the second fun fact. And the third fun fact that, after going through these cycles of startups, exiting, participating in those startups, he has built up immense amount of experience. And now he has narrowed down to the multifamily and the real estate. And he truly believes in that. And not only believes, and he is building something quite a bit substantial for our audience to even listen in and understand, because it could be complex, and Glenn has this tremendous ability of spelling it out. So we are going to jump into it. But the last fun fact I do want to mention that, Glenn is a tremendous wealth of knowledge and education and giving. And I have had a chance and, privilege to actually experience that firsthand. I'm so proud and excited to call Glenn my mentor, and Glenn has been mentoring me, just looking at, what I don't do, how I can tweak some things, which just, quite honestly makes that 2 millimeters difference in the strategy and the way I'm thinking about it. So Glenn, very grateful. Thank you so much for all the time you have been spending, absolutely selflessly, and being my mentor. I truly appreciate that.
You're welcome. It's a pleasure.
Thank you, Glenn. So let's dive into it. Let's dive into your entrepreneurship journey. As a serial entrepreneur, do you want to just give us a kind of a glimpse into your backstory? How did you and what you have done to be here? And I don't know if we can finish the entire story in one episode, but at least a highlight of it, please.
Yeah, I can do that. We haven't talked about this, but I'm dyslexic. And I think being dyslexic
Really?
forced me more into being an entrepreneur than if I wasn't, because I always like to figure things out, how they work. And I can't always do it with a book because I read too slow. So I dig in and get my hands dirty. And I had the opportunity right out of high school to go to work for a family business that built at that time built patterns for the foundry industry, wood patterns. And I served an apprenticeship at the company and went to school nights working on an engineering and management degree. That business turned into making steel injection molds for plastics. In fact, I saw Michael Dell has become very successful. We actually built his first plastic keyboards and monitor housings. I think probably back in, if it wasn't 78, it would have been 1980 timeframe. And from there, I got involved in the family business sort of by default, which was an entrepreneurial type business. And I was 20 years old when I had an operating division under me. And when I was 24, I had the whole company reporting to me. And we had some pretty tough times. We had union strikes. We had the Volcker interest rates. They went from 9% to 22% overnight. We had millions of dollars of heavy equipment that was on loan, and it nearly bankrupted the company. Not unlike what happened in the real estate business recently. It was
Right.
much more severe.
Mm.
that experience, it's all part of entrepreneurship. I learned that you have to block and tackle and solve problems. And the key is to never give up, because it's when it's hard is when you make the greatest moves. You start to have the courage
Right.
to fix it and grow it and get on the other side. So
That's amazing.
that's a little bit about how I got involved in entrepreneurship, and it just sticks with me.
Yeah, that's very interesting, being dyslexic and kind of taking that as power, not as a limitation, and just, digging much deeper and intrigued by different topics and subjects. I think that's really commendable. Uh, tell us a little bit about your entrepreneur journey and the different type of, startups or things that you created, and kind of an interesting journey on that side before you landed on multifamily. And I would love to know that, why multifamily, but let's just talk about that business well a little bit.
Yeah, so I was 47 years old when I sold the Hanson Group Limited. My brother and I
Hmm.
built it from, we actually purchased it from the family in 1991, and then we decided to scale it, and we grew it to 400 people. And we had a private equity group, come out of California and pay more for it than we were surprised at how much value we created. And the reason we created the value even surprised us more. And I learned about private equity exiting and how you sell to those people. And the magic is you create value that gives them the opportunity to invest on a multiple of earnings. And that's where value creation is. As far as where I went from there, from retirement at 47, I got bored and I started with three other people, an angel investment group, and we grew that to 35 members. And as a result of that, I was involved in personally investing in 25 startups, and most of them failed,
Mm,
as you guys know, right? There's an 80% failure rate, and we participated in that, but we knew that was the outcome, and several made it. And there was a common theme to why they made it, and that led me to other businesses to buy. The theme was that if you want to do something that cannot go to China, it's wildly
mm,
profitable, scalable, doesn't
mm.
need skilled labor, and if you can get it, recession proof.
Right.
And so fast forward from 1999 when I sold the company to 2007 when I launched my own company. Instead of investing in others, I launched a company doing roll up of pet crematories, and the goal was to go across the United States with these things. I had done a lot of research. They're very profitable. They're tiny operations, and there's no systems to manage them. So what I did is I brought the systematic programming concept to the acquisition model, and
Hmm.
we created standards and operating systems so that as we added more crematories, we could manage them and build that enterprise value that somebody paid me for on my manufacturing company.
Right.
So we focused on the end game rather than the issues that day by day. We knew it was going to cost a lot of money and there was a lot of work to do. We did all the work, and then somebody paid a high multiple for the
Right.
company. So we
Right.
started the pet cremation business in '07 and exited, I think it was 2016. And then in 2008, the same month that Lehman Brothers went bankrupt, I started
Hmm.
real estate investment business in multifamily. And you ask,
Interesting.
why multifamily? And I'm surprised we did it too, because my wife and I had purchased two families back in the late 70s, early 80s, and we hated it, got rid of it. And then we tried it again in the late 90s, hated it, got rid of those again. Then we decided that to do it, we want to do it at scale. So my first multifamily property at Colony Hills Capital was a $36 million transaction in Hoover, Alabama. So
Interesting.
that was deal number one. Deal number two was 14 million. Deal number three was 100 million. And I was able to think like that from the years of helping entrepreneurs build startup companies. You know what it takes to make it work. And I had the experience of having exited to private equity twice now.
Right.
And that helped me to fine tune my model and focus it. So what we're doing at Colony Hills Capital is we're scaling it for an exit in 7 years from now.
Wow. Wow. So let's actually, unfold. There's so much that you just explained, right? And I would love to unfold it and just make it a little bit easier for our listeners to just tune into what it really means, what you're saying, right? So first of all, having the exit, the roll up strategy to exit to the private equity, right? So let's talk about that. And you know how I really like how you have created the same strategy in multifamily, because real estate just considered as an asset level, right? You invest in an asset, the asset exits, the real estate investment exit, and it gives you whatever you have, right? The gain, the equity gain that you have. But now you're talking about the value add as a business, right? So let's take, by the way, very interesting, very, very interesting, business, the pet crematory services, right? Uh, so let's talk about what the value creation in that is, right? When you're talking about roll up, we are talking about the multiple. When we are talking about exiting as a rolled up to private equity, right? Can you explain our listeners a little bit in detail about what it means, what it means to increase the value of a business? And we're talking about probably the EBITDA, and then what it means to roll it up. So it's again that second layer builds up for the next layer, and what is the multiple that comes into play in the picture when you're exiting.
Yeah, great questions. It's it's grueling, dirty work to build a business. Those of you who've
It
done
is.
it know it. And there's lots of high rise enthusiasm, and there's lots of low plateaus to fight through.
Right.
So I think the key is, I know that the key is to build with the right people and put systems in place, systems and procedures. And
Mm-hmm.
because I'm a pilot, I'm a fixed wing pilot and a helicopter pilot. And the disciplines that go on in the aviation industry are so much more appreciated and followed than any other industry I can think of. And an example of the value of what happens in aviation, in manufacturing, which I also did at high volume, there's a 1% scrap rate that occurs in production that's acceptable.
Mm-hmm.
That means 1% of the products are either repaired or remade or thrown out. If the airline industry had a 1% scrap rate and it was acceptable, we'd have 30 planes a day falling out of the sky.
Wow. That's scary.
Yeah, so if it means somebody's life, there's more attention to the detail, right? So the people that are successful in business are the ones that are paying attention to the detail so that they don't have that scrap. And it might not be in the case of real estate, it might not be in the case of throwing product away, but we throw money away. There's a huge amount of inefficiencies in the space. And since starting Colony Hills Capital, I've been focused on trying to solve that. And I even hired a full-time person, VP of operations, 3 years ago to focus only on systems. We did
Right.
that with pet cremation business, and that was the value creation. We've been struggling in the real estate business with how to tie all these people and processes together. And the gift has come to us, and it's Claude, the AI. We have implemented so much of that very quickly, and it's reducing the need for labor to do repeatable tasks. It's more accurate, it's quicker, it gives us access to data better. So the idea of focusing on building the system is where the real value creation is, because one, you keep your employees, two, you can demonstrate where you need improvements and where you're doing well. And then ultimately you get a cadence going of performance. And that's the opportunity for the investors in Colony, is that cadence and performance can be sold for a multiple of earnings. And in the business of what we're in at Colony Hills Capital, the multiples are paid out at a 7 to 10 times earnings. So you say to yourself, who would pay that much for a real estate investment firm,
Yeah.
and why
Yeah.
do they do it, right? So they pay for it because the work is done. So they're buying
Hmm.
critical mass and cash flow. They don't have to deal with what we're dealing with, where we're short on cash. We've got to, give up equity to bring in cash. We got to fund the business ourselves. All that is gone when we get finished. All that'll be gone, and we'll have a cadence of successful profitability and growth. The other thing is, the people that want it are those that deploy enormous amounts of capital. If you think about it, if somebody's got 500 or $1 billion to put out and they place it with me, I make money on it. They don't. They make money
Right.
on the investment, but not on what I make. So if they can buy the business, they can keep all the cookies. The profits that are made by Colony Hills Capital or
Right.
other GPs, that money, a portion of it can go to the acquirer, or they can keep all of it. So now they've put their 500 or $1 billion out, and they make their normal income, but then they make on top of that what the operating company was previously making and paying to Glenn and his investors.
Right. Right.
So that's the model that private equity people look for, as I know it. There may be other avenues and things and tricks I'm unaware of, but
Love it.
that's what we're targeting.
Love it. So, I love the fact that you just mentioned that, the scrap rate, that's so important, A business like an air, the flights, if there's that scrap rate is acceptable, what disaster can it happen, right? So I like how you're looking at that, making the system or systemizing this so that it over and over again, it just works like a machine almost, right? That it's scalable. And I think that's when, looking at that, the pet crematory business that you had, when it could be mom and pop owned, it could be everything, including the daily processes, the daily steps that they need to take, from getting the clients, the marketing portion of it, the finance portion of it. So now you're systemizing, you're creating a system, almost like a blueprint, right? Like a cookie cutter. When we see the single family homes being built up, that, there's, 4 plans or 5 plans in a master plan community. And the one plan is built very similar to others. So similar to that value creation in a business is kind of building so that it's kind of repeatable, it's same, and it's scalable. And now you apply that to multiple businesses and you pull them together. And if they're making whatever, the EBITDA, which is the profit in a sense, you can now get a multiple of, so if they're making $1 million, you can get a multiple of, say, $7 to $8 million. Sorry,
Yeah,
7 to 8 times.
that's
That's
correct.
that's about the value creation, right?
Yes, and
Uh,
it throws people off when they look at investing. They're saying, I'm investing with you because you're going to do an 8-time multiple. How do you do that? And I say,
exactly,
we
exactly.
can't do it yet, but we will do it in 7 years.
Yeah, and that's the beauty of it, right? I mean, that's why probably Tony Robbins, in his one of the recent books called "It's a Holy Grail," right? That GP stakes. So again, I love how you just explained it to model it from a pet cremation to real estate, right? Now, real estate, as we know, that there is even syndication. I'm just going to keep it to syndication, not to the rental. But you invest, say, your 100K into real estate syndication, you get maybe 7%, 6 to 7% cash flow, and you probably get 15%, 16% IRRs. So you might see, 2x of your money, including the leverage, the loan that has been included in the real estate. So you might see that 2x happen in 5 to 7 years.
Yeah.
But now what you are bringing, and let's, go a little bit deeper on that side, what you just mentioned, right? So LPs typically just look at investing into the asset, but you're inviting them to invest into the team. And when they invest in a team, it is actually going to be investing into Colony Hill's business, the past, present, and future. So whatever in future also, fees, you know, the asset management, annual, and also at the end, what you will make as a GP, as a general partner, to have use your expertise, your experience of managing it. Now they actually get a parallel piece of that without actually working hard for that. Is that how it works?
Exactly. Yes, it does. And go, go back to the pet cremation business because everybody likes that story. And by the way, pet aftercare turned out to be a hot market, and we shouldn't have sold it. We should have kept it and
Oh,
continued to scale it because
right,
pets
right.
are part of a family now. But what we look for in an operation like the pet business or like real estate is where can we improve? So, the time that it takes to cremate an animal is an hour and a half. We were able to reduce it to 15 minutes. And then we could
Wow.
combine the crematory ovens so that there was one smokestack per 10 ovens. And that reduced our cons- fuel consumption and bills by like 80%. And
Mm.
those are big moves. We're moving the needle, and to do that, we need investment dollars, right? You can't do that without money. So we sell off parts of the company, just like they do on Wall Street, right?
Yeah,
SpaceX is an example. They raised money, never made any money, but they just poured money in so that they could get the big heyday, and they did, and they deserve it.
right,
They took the
right,
risk.
right,
So parlay what I just said into multifamily, we're doing the same thing with the operation to make it more productive. And in order to do that, we need investment dollars.
right,
We need people, we need systems, and we could self fund, but it's actually safer to bring in some outside talent. And with that, some investors bring significant talent with their money.
right,
So it's not just bringing in investors. If we can find investors with talent, that's even better.
right, right. That's very interesting. That's a very interesting, kind of a perspective. So let me kind of again step back. The understanding is to bring in investor capital, not just for the capital, but also sometimes it's the expertise that they bring to the table. And it's really the burn to support the churn, right? That's what we are building.
How did you know that? That's funny that you said it. Burn the churn.
It just came to me, the burn and the churn. It just came to me.
Yeah.
Let's talk about that a little bit
I
more.
tell you what, I know how to burn it. And you just have to have the courage. You have to do it.
Right,
Recently I just hired a group to help us learn how to market and sell and raise capital. And you'd think, well, geez, with all that I've done, why am I paying somebody to help me, right? Well,
right,
because I'm not doing it good enough. I don't. It's not. There's always room for improvement, no matter how good you are, right?
right, right,
And helicopter pilots train all the time. You don't. Passengers don't see that, but we train. And building a business is the same kind of thing. You have to just keep doing it, get better and stronger,
yep,
faster, cheaper.
absolutely,
Yeah.
absolutely, love that. So tell me about from the investor perspective. Please share with me that, I mean, to buy in and move that capital inside a company which is, so big. I mean, you're such a big company, right? 1.3 billion in transactions. So do they need like a millions of dollars to participate, or what is the size of the participation?
It's it's the same thing as buying equity in a public company. You can pay the share price. So
Right,
we value the company, and then we decide what the value is and what we're going to sell off. And the investors can buy the whole round, or they can buy a small piece of it. And it's actually pretty exciting for people that haven't touched a business like this. When you invest in an operating company with your own cash, and it's not a publicly traded company, you're watching the team sweat. You're watching them succeed, And you
Right.
start to, I get investors calling me up and, they want to know like, well, what are we doing? How did we do? And when it doesn't go well, they don't whine. They say, can I help? What can we do?
Mm. Right.
What, how are we
Right.
going to fix it? Um, it's actually, it's like a private club. The people that are invested in there, we have the same vision and we understand the risk. That's, I think what matters is you don't want to invest in a GP position if you don't know what you're doing, right?
Right.
You have to understand that you could lose your money, and
Right.
as long as that's an acceptable uh, point in your thinking, then go for it, do it, and enjoy it.
Yep. Yep. No, I think that, it makes sense. I mean, everything is risky. Investments especially are. But understanding just a different bucket and diversifying in different buckets kind of makes sense, right? You always encourage that, because it investment is right for somebody else, it's not right for you. So you need to do your own due diligence on that. But going back to what you were saying, right? And we talked about in bits and pieces relatability with the businesses, the predicament relationship between how it applies to multifamily. But to keep it clean and simple, by the way, it's great that you know that even at a smallest chunk of money, like say 50,000, they can participate in this GP opportunity, right? So just to keep it clean and simple, if somebody comes to you and say that, hey Glenn, what about Colony Hill? What exactly is this GP opportunity? How do you simplify it, and how do you like share it with them in a way that they understand it? Because it is a quite a bit. I mean, it's treating real estate as real estate itself in syndication. It could be complex for some people, but
It
now
is,
treating real estate as a business is even more complicated.
yeah, but it's not if you think about the fact that if you want to do real estate, we raise money, we can put your money into real estate. So we can buy a deal in Houston, Texas, and park your money there,
Right.
and you're at the whim of the market to the extent that it goes up or goes down, right? That
Right.
investment's in one deal. Or you can look at another way, say if I invest in the operating company, I have a piece of all the deals because we own and manage those deals with other partners. But again, when you finally get these things tuned up, these operating companies tuned up, they continuously make money. But it's a long road. It takes a while to get there. To scale the business takes time, and people have to be patient. So how do you explain it? If if you've got time, you don't need the money, and you can wait 7 years. It's a significantly better return than any single property is going to get you. And you could argue that the risks are lower because if we buy properties and some don't make it and others do, the ones that don't make it, those were losses for the investors. Where if they owned a GP stake, they get the benefit of the amortization of all the deals into one bucket of profit or loss. Right? It can go either
Right.
way.
Right.
But it's like I mentioned earlier, it's a cadence. We have to hit that cadence, and once you start to hit it, that's when everybody thinks your IQ went up, and they start treating you like you're somebody else. You're still the same person you were all along, but
That's true.
perceived as smarter, right?
Yep. Yep.
The smarter people are doing what I'm doing right now. They're biting it. They're biting into it early, and they're struggling and fighting through it for the big win. The one
Mm.
at the end, that could be luck, right? So
Absolutely. No, I love that. When you're looking at what you just explained, it's a kind of a diversification of the risk, because the risk managed approach is what investors should always think about. And now you're getting distributed on the all different properties. One can do better, one can do subpar. But if you have that blended risk, I think that diversification is the key. So thank you so much for explaining that in the simple terms. I could go on with this conversation on and on, but I think with our podcast we still have a couple of more things to cover. But this is incredible, in terms of the GP stakes and how they can participate and just understand, right? So I would highly encourage listeners to listen to it and go back and listen to it again, because it's a little bit complex. It's a little bit complex to understand it. But the fact that you are getting something being created over the period of years, and being able to participate as the GP side of it, as the company side of it, that's incredible. So Glenn, I do want to ask you one question: that when you're looking at future of Colony Hills, right? You have done tremendously well in the past. The future of the Colony Hills and the future of multifamily in general, right? We have been in mayhem for some time now, with the interest rate just rapidly increasing on all of us, right? So there has been a lot of distress, especially in multifamily. But at the same time, we cannot ignore the opportunities also that's uncovering, right? So, what is your outlook for Colony Hill's future and just general the multifamily market, where it's going and what its future in next couple of years looks like?
Yeah, so it's raining really hard where I am, and it's so loud on this roof. I'm not sure I heard precisely what you say. So I just want to make sure you're saying what's the future of multifamily, or what's it look like based on the interest rate rise? That's what you're
Yes,
asking?
yes. What's the opportunities and what's the kind of
Yes.
a fear that we have in the market?
Yeah, I told you when Paul Volcker took over as Fed chair and he raised interest rates to 22%. I got crushed, right? There was everybody got crushed. Anybody who was borrowing money was hurt. Anybody who had a 401k was making lots of dough. It's not much different today than it was then. The world survived, right? Back when Volcker did this, and yes, we did have some significant strain on our properties because of interest rate rises. And it wasn't just the interest rate rise that caused the strain. It was the fact that the banks required that we have rate caps on the variable rate interest so that they know that their assets protected. But those cap rates were worse from an expense standpoint. It was more damaging than the interest itself. And some banks required that the money be put into the deal a year ahead. So all of the operators that were using variable rate loans, they had the same stress point. So that's gone on across the market, and it's created a wonderful opportunity for people who are still in the game to buy at lower prices than they were, and then ride it again, ride the wave back up again. And that's the world we're in always. It's never straight up. And it's since 2008, we had a little bump during COVID in the markets, but it's been pretty solid right along. So people
Yeah.
haven't experienced a downturn, and it's hard to comprehend. This is where, from my perspective, the losses that people entailed because of interest rate rise seem like a lot when you're trying to carry the debt. But at the end of the day, when you're doing what I'm doing and you're getting to this massive exit, it's just a little bit of noise, right? It's like you just gotta. We're fearful. Don't get me wrong, but we're not afraid to open the door again and just go. And
Right.
so that opportunity is here now. It's just starting, and we we will take advantage of it. We've repositioned our access to capital, additional capital from foreign countries, and
Interesting.
I'm confident that we'll be rocking and rolling here in the next 12 months.
Love that. I love that. And I love to see, how the Colony Hills progress goes from here. So if I understood you correctly, you're cautiously optimistic in this market. You're cautious, and that's what is needed.
Oh
And
God,
you're
yeah,
optimistic.
we're cautious. We've we've um, we've underwritten deals 9 ways from Sunday to make them work, and we can't. The
Right.
math doesn't work, so we've been on the sidelines for a few years now, so
Right.
waiting for this to come around.
Love that. Love that. Well, thank you so much for sharing that. And with that, we're gonna, go into the next segment. If the listeners want to get in touch with you, how can they connect, or you or your team? I don't want them to
Yeah,
jumping on your calendar, but if they're to connect with somebody to understand a little bit more about
yeah.
Colony Hanson's journey.
I think that the safest thing is just to reach out to me, and I'll
Okay,
pass it on
correct.
to the right department that can help. But the email address is Glenn Glenn dot Hanson Hanson at colonyhillscapital.com, and that's the best way.
Thank you, Glenn. It baffles me your availability. So thank you so much for giving your direct email address to our listeners here. But yeah, I think going into the next part, which is one of my favorite and most kind of close to my heart, right, is the segment about think outside the stocks. It's not about the company, but it's about that think outside the box kind of a mindset. And I like to learn from our listeners that how are they thinking outside the stocks or, of one particular strategy. And I often investors, when they come to me and they ask about my next investments, my returns in the next investment, I talk about, you know, changing a perspective a little bit. As a frog in a pond, we might see the problems around it or the solutions also around it, right? But when we change our perspective and we becomes that eagle's eye perspective, now we see the forest, we see much more different problems, and we do see much more different solutions as well, right? So that's the perspective about not just creating wealth in one particular track, whether it's stock market, whether it's real estate or anything else, but it's about how you can grow, preserve, protect, and pass your generational wealth. So keeping that in mind, I would love for you to share with our audience the journey over the period of time, years, that you have experienced, that you're actually put some tools and techniques in place to not just grow and invest, but to grow, preserve, protect, and pass what your legacy is going to be. So would you help us highlight on what your lessons have been and how you think differently, not just
Yeah.
outside the stocks, but just differently?
So my experience with having wealth back in 1999 was challenging because we had the dot-com crash right
Hmm.
after. Within a year of selling the business, I had moved the money to professional money managers, and we got crushed. I mean, like real significant losses. We lost more money. My brother and I lost more money in 18 months than we ever thought we'd have.
Wow.
And we pulled the money out of that manager and we put it into another one. And then they assured us that what we saw was a 100-year flood. It can never happen again. There can't be another dot-com crash. And then there was in 2008, Lehman Brothers went broke and the whole world came to an end. It almost seemed like to us a nuclear bomb had exploded and the sky was gray every.
Gosh. My
So
gosh.
to answer your question is back then I didn't know anything about money management. I was a tool and die maker. I was a sales guy. I was a business owner. And, I knew that I had to make a certain amount of collections or I couldn't meet payroll. I got that, but I didn't understand the global markets. And so what I've done to help protect that for the next time when it comes is spending time with people that are focused. There's groups out there that you can join, and they focus on how to preserve their wealth, and they share their tools and their models. And I've been participating in that kind of thinking for the past few years in anticipation of my last liquidity event, which is when Colony Hill sells, will probably be the last one I do. Um,
Right.
that said, I'm still starting. I am starting another new company this year. So I don't
You
know.
are. I need to know a little bit more about it. Maybe we can talk on the side on that. So, but yeah, going back to that group that you're talking about, and I know you cannot share the names because it's very coveted and very private circle of wealth almost. But it's a ultra high net worth group, right? The buy-in to qualify to be into that group, the qualification itself is pretty up there, right? So what does it look like, the qualification to be part of this
Yeah,
circle?
the groups. There's different ones. They all have different price points, and
Right.
if you get online and look for them, you can pick up what they do, and they usually, a lot of them publish what it costs to participate. But from the perspective of protecting your wealth, it's inexpensive compared to not having the experience or not knowing who to go to, right?
Right.
You
Right.
really need what we should have been taught this stuff in college and high school, but we're not, right? We're not taught how to manage money at school in school. Um, I I'm doing it because I recognize that's not my strength.
Mm.
Knowing what to do with cash. I know how to run a business. I know how to raise capital. I know how to make money. But then once you make it, where you park it is important to
It's
know.
very important. Yeah.
Yeah,
And it's better than, reinventing the wheel yourself to be part of. And some of these groups are like even like $1 million in liquid assets sometimes, that you need. It's not just about the net worth or ultra high net worth to be able to participate in the investments and stuff like that. So the higher the tier, higher these groups go on. But what's really important is, like you said, that, to blend yourself with this group where these discussions happen and be part of it, and how you can implement and bring in, right? And think outside the stocks also, it's a group, the community that we have, we talk about a specific strategy, a specific kind of holistic strategy, right? That's called wealth in the vault. So starting somewhere is important, not reinventing the wheel. And having your own successes is great, but having your own failures could be costly. So
yeah.
thanks for bringing that point, that mentorship and the groups, it's so important, to recognize that you need help and to actually go and get it. That is so important. So thank you for saying that. So with that, I'm gonna go into the next round, which is kind of a fun round. Unless you want to add something else, to how you
I
you
want
can
to
think
add that
outside that.
your model on think outside the stocks is exactly what protects the money from being lost, so people can have
Mm,
comfort at night. And that's something as an entrepreneur is hard to it's hard to comprehend because we are playing in a risky game all the time, right? We're always
yeah,
always
yeah,
putting it out there. And I really think if somebody were to be in a position where they've got over $1 million in cash and they don't know what to do with it, they should talk to people like you. And I
yeah,
should have
yeah,
done that too earlier in my life. And I didn't even know they existed, right? I mean, how
yeah.
nobody
Very,
else, yeah.
very private. Very, kind of coveted. They can't even search for it at times. No, but thank you for sharing that. Appreciate it. So with that, the next round and the final round is going to be the rapid fire round, and I like this because it's like it gets just beyond the business, which what you have done. It gets to down to what you have experienced and what you are as a personality, right? So whenever you're ready, I'm gonna start the rapid fire round. Are you ready for that?
Okay, I'm ready. Hit me with your best bullet.
All right, right. So since you have been part of such various different startups and you have seen more failures than successes and learn from those, successes, what is the failure that was really hard to take? And you talked about a lot, right? But what was that failure that is just like, oh my gosh, it was just nick in time, you know? Can you share that story
So the failure of, I'm not following what failure that you would mean.
of the business, right? I mean, I think you were sharing about, being in the part of the technology that was ahead of its time, and you're almost there, right? And something
Yeah,
happened. So
so
yeah,
yeah, we had one of my startups was an aerospace company. We built unmanned air vehicles and unmanned air vehicle sensors, and that was in 2003. And I bought in heavily into the startup. There was just one fellow with an idea,
right.
and
And that's the
I
drone technology in simple terms we're talking about,
yeah,
right?
it's a drone. Essentially, it was what guides a drone's missiles to the target.
Right.
Today they fly the drone into the target. We were working on something where the drone would release a missile.
And
And
when was this?
this was 2003 to in 10 years, I raised $18.5 million for the company. and we had government contracts. Raytheon, I think, was one of them, and in the hundreds of millions. And when Obama became president, he voted out the military budget, and we
Mm.
lost. We spent we had a burn of $330,000 a month, and and we went from thinking we were on top of the world to nothing, and we had to shut it down. We just didn't have the staying power to recover. So
Right.
yeah, there's failures, and they hurt, but they teach too, right? There's learning in these things.
Yeah.
When
Yeah.
I mentioned my filter in the beginning of what I would invest in, part of the thinking was that those failures helped identify my criteria for what I
Right.
would invest in.
Right. Wow. Glenn, your story is a story of resilience. I mean, I have had my share of, ups and downs, and it's nowhere close to what you have seen. And every time, it's just so much of resilience and, knowledge and expertise. And there's just that wiseness to be doing something bigger and better. It's incredible to see that, right? So my next question is going to be a little bit personal, right? Uh, 20 years old, if you had to go back and tell your 20-year-old, or when you're restarting, what would you do differently? What would that 20-year-old would have some wisdom, some nuggets of wisdom from you
Yeah.
that would
So
help?
my story was when I was 20 years old, my mom died of breast cancer,
Oh, I'm
and
so
my
sorry.
father was so much in love with my mother, he couldn't function. And
Oh,
so that's how the business defaulted to me. My older brother was in the Marine Corps, and my younger brother was only 15. So it was on my shoulders to figure it out. And so
mm,
what I would do different, I would pray it didn't happen again because it was ugly. It was a hard time. But when you're, I don't know why I had the conviction to do what I did and stay with it. Um, there were a lot of people that helped me inside the organization as we grew, but there were also a lot of people that were awkwardly jealous. And
mm,
those experiences taught me how to manage people. So while it was ugly at the time, it created the character I have today to handle strife, problems, employee issues in a
mm,
fair, caring way. And so I think it was good for me, and who would have known? And on top of working in the manufacturing company, I went to school nights for 14 years to get a degree in engineering and management, and I never
right.
never closed off the degree because I took courses that were appropriate for my business, not
Oh,
for
interesting.
yeah, wasn't it? And I really
Yeah,
I
yeah.
enjoyed going to school. It was a break from the stress.
So you were on your own roadmap.
Yeah, that's it. I got my own degree, my own diploma.
Yeah. Wow, love that answer. And the last question I'm gonna ask, or maybe one more after that, but the last question and rapid fire is like, I mean, I have met you and I've met Krista, your wife as well. You're incredible people. I mean, I have never seen such modest, such down to earth after having, so much of achievements. And you think about it, people around you, company as well, in different ways. Uh, what is one impact that you have done in your life that is just kind of, just different, and you never thought that what it would lead to? And while doing it, it just felt immensely, immensely gratifying to do that.
Yeah, so when I had a lot of money after the sale of the company, my brother and I funded the full budget at Mass General Health Professionals. That they were creating a program to help teach kids to deal with dyslexia and how to read.
You
And we
did.
fully funded it so that they had an operating budget to complete to success.
Mm.
And when I was negotiating that with them, I was thinking like an entrepreneur and a private equity guy. And I says, "What do you guys need? How much do you need to get to cash flow positive?" And
Right.
that was amount of money we gave them. So today there's millions of kids that have benefited from it, and their operating budget today is 8.5
Wow.
million, and
Oh my
they're working
gosh.
their way into the New York school system, and they keep chipping away at it. It's called the Hill for Literacy. Is the name. Hill is Hanson Initiative for Language and Literacy, and Hill for
Okay.
Literacy is what it is. So that was a big deal because we donated funds over the years, but it was $100, $10,000, or even $3. We made a difference. We had our hands on the controls, and we made a difference that really mattered to
Hmm.
so many people, and it still does today. It's live and operational. That was
Wow. So
25 years ago.
that is incredible. And year after year, actually, it's making impact, and the impact is growing. Well, thank you so much for sharing that. And it's just mind blowing to even think about how many people it has helped. And I mean, it's not just the life of a person, life of a child that you're changing, but it has gone through multi cycles of creating these adults, having their families, and how it impacts their families, their kids, their spouses.
Yeah.
So you kind of have, it gives me goosebumps, my goodness, to think about how, like a domino impact that you have created. Wow. I had not known about this. I'm so glad I asked this question. Thank you so much for sharing that. And thank you so much for making that such a positive impact. Incredible. My last question, then, the bonus question is going to be that, you and Krista, you travel a lot. So, what is that one location that you kind of go back to again and again, which feels the most close to heart, most peaceful when you travel, whether it's here in US or internationally? What's your
Yeah,
favorite spot?
I think Krista is Greek and Italian, and we both like Greece and Italy. So I think that's probably the place we would go. Those.
Oh, love that.
Yeah. But I also like California. You can't beat the weather, right? That's pretty.
I don't know why I moved away from California, right? I mean, it's 2008. We had to do
Yeah, but
things
when it's
differently.
110 degrees, you wish you were in San Diego, right?
Tell me about it, right? So with that, I mean, has been incredible conversation. What is the one last message that you would want to give to entrepreneurs coming back from this tremendous golden wisdom of nuggets that you have dropped all over this episode? Let's conclude and be grateful about what we have. And then what's that last kind of
Yeah,
a
the last piece is get dirty, right?
mm-hmm, mm-hmm.
People have these ideas, and they're wishful, they're wishing, and it's not hard once you get started. And there's people out there that'll help, and the angel investment groups are the place to go with your ideas, and just
Yeah.
do it. Get dirty.
Love it. Love it. So get dirty. On that note, we will conclude our episode. Again, thank you so much for this incredible, just sharing this incredible experience with us and have this conversation, going through your journey, uncovering some rocks in your life, and as well as adding value to us and adding impact to others over the period of years and years. Glenn, I'm so grateful and thankful to have you in my life as
Like,
a mentor, as a person, as an individual. Thank you so much for everything that you do.
all right. Take care. Thanks for
Thank
everything.
you so much. Absolutely. So, listeners, there is a lot to learn on this in this episode. Yeah, we learned about the GP stakes opportunity, but we learned about resilience. We learned about getting dirty, as Glenn says, and hope that kind of uncovers something in you that's tried in you to be a little bit different, to cause a little bit different impact, and make that 2 millimeter shift in what you're doing today. Glenn has been incredible encouragement and inspiration to do that. And thank you so much again for joining and listening and tuning in. I look forward to see you in the next episode. Thank you so much again, Glenn.
Here. Thanks. Bye-bye.
Thank you. Me.
Thanks for tuning in to the Think Outside the Stocks podcast. If you enjoyed today's episode, please like and subscribe. Madhavi is on a mission to change the financial trajectory of one family at a time with 1,000 more to go. We hope you'll be a part of this vision. Please join our growing community, and to get your journey started, visit thinkoutsidethestocks.com to download your free guide on active income with passive real estate investments. If you learned something new, please share it with one person today. And if you have 60 seconds, please leave us an Apple